Welcome everyone, and thank you for joining the CFA Society Switzerland's webinar on the COVID crisis, economic impacts from a banking sector perspective. Please use the Q&A symbol to ask questions or comment on questions. After the presentation, these questions and the questions previously submitted will be discussed. Please also complete the preliminary poll, which will be reviewed at the beginning of the presentation. The poll will be closing in the next few minutes. Many thanks to our sponsor, JP Morgan. Today's speaker has special insight into how the COVID crisis is affecting the economy, government policy, and in particular, the banking sector. Dr. Martin Hess has been Chief Economist and Director of the Swiss Bankers Association since 2010, and is a member and Chief Economist of the group of European Banking Association. Welcome, Dr. Hess. We'll be closing the poll now and starting the presentation.
Thank you. Thank you, Sheila. Thank you for the introduction and for the invitation to this webinar. I'm just trying to put this screen. I see now the questions and the answers. So I see that on the question, where will we get back to normal in Switzerland after the crisis, 51% voted maybe yes or no, no fundamental changes in the economy, but a persistent welfare loss. And the other 50% voted half and half for yes, there will be a real persistent welfare loss with fundamental changes, and other 21% saying that no, the welfare loss will be overcompensated, and after the crisis will be back to the old normal. On inflation, participants are pretty confident that the Swiss National Bank will be successful in achieving the inflation target. Some think they drive up prices, the crisis, and some think that due to the crisis, the inflation will undershoot. So I hope that I'll be able to give some insight during my presentation on those two topics. And I am going to share my screen now. Can I share my screen now, Sheila?
Yes, you should be able to share your screen.
Can you see my screen?
Yes.
Good. I'm clicking now on the presentation here. Okay. So it works. So I think I am going to talk about two parts in this presentation. The first part being an impression on how the crisis evolves globally, but also in Switzerland, giving some forecasts. And in the second part, I would like to talk a little bit more about future challenges, like restoring competitiveness of the Swiss economy, about monetary policy, and also about how pension funds and social security system is able to achieve its required returns. The Swiss Bankers Association has played a pivotal role in setting up the credit facility, backed with 40 billion government guarantees for the small and medium enterprises. But its mandate is also to ensure good framework conditions in the future, and therefore we dedicate quite a lot of resources to that topic. I mean, Corona crisis, George Clooney would ask, what else at the moment? I think a good slide to start with is just giving a sense of the impact of this crisis, namely the initial jobless claims in the US over the decades. Normally, a few 100,000 were applying for a jobless money every week, and now it's into the 6 or 7 million by the end of March. Now, of course, it comes a little bit down. I could have used many indicators to show the gravity and the singularity of this crisis, but I think this gives a sense of urgency to act. We see also the press full of historic comparison. It's worse than the financial crisis. It goes back to the Great Recession in the 1930s that we have not seen anything similar. And SECO says for Switzerland that GDP is set for sharpest fall in decades, namely since dating back to the oil crisis in the 1970s. What are the forecasts of the International Monetary Fund for the advanced economies? Here you can clearly see that Q2 will be the big slump with a pickup in Q3, but never the International Monetary Fund thinks that the economy will overshoot, and so the welfare loss is likely to be persistent. IMF also said that these forecasts are really bound to a lot of uncertainty. What is striking, however, and if we go to the panel on the right side, number 5, to the advanced economy government spending, here there is the extra spending over the already higher spending for 3 different scenarios: for a prolonged lockdown in the blue line, for a W-shaped crisis, so a short lockdown in 2020 and a short lockdown in 2021, and then a combined crisis in the yellow line. And this amounts, of course, to an ever-increasing government debt to GDP ratio over and debt to GDP ratio that is already higher after the crisis than before. What can we take from this? It seems somehow rational, and this is for the IMF and also for the SECO, for the Swiss government, that the base case forecast is always the best case forecast. So there is a lot of downside risk to these forecasts, I would say. And the reason for this is obvious. In this McKinsey study has asked households about their degree of optimism about how their country will recover after the COVID-19 crisis. And they will also ask, how much will you do you plan to spend? And it's very obvious, and it's logical too, that more pessimistic countries or households, more pessimistic households will tend to decrease their spending, and more optimistic households will either stay the same or even increase their spending. So governments have an incentive to have their households and their firm being optimistic, because otherwise a deep recession would become a self-fulfilling prophecy. And according to the dimension of this crisis are also the measures being taken. On the monetary side, and also here as an example for other central banks, is the QE program of the US Federal Reserve, with 4 consecutive quantitative easing rounds, the latest being of 1.5 trillion. And it's very well in my memory when during the financial crisis they came up with the first trillion of quantitative easing, and people thought this was mind-blowing. Now we are at almost 6 trillion cumulatively speaking, and people are even thinking of a QE infinite. So here we had a real monetary expansion. This is also true for other big or for other central banks in important countries, whereas the S&P 500 index was up, and also the economic development was very positive in these countries throughout this decade. Not only the monetary stance, but also the fiscal stance was expansionary. Here to the left, you see a panel with the 35 largest countries. And of course, after the financial crisis, many countries had to tighten fiscal stance in order to bring their budget in order. But somehow the discipline over the decade was less and less. And therefore, many countries today struggle in pulling together a package of measures that is up to the task. We see how, to the right panel, how the indebtedness has evolved over the last 20 years, and there was just one direction, it's the direction north. So this is a broad overview of the key factors on a global scale. If we go now to the Swiss forecasts of SECO, we see the red dashed line. SECO estimates that within 2 or 3 years, we will have recovered from the crisis to the level 2 years or 3 years back. For this year, it estimates minus 6.7% growth, GDP growth, and roughly 4% unemployment rate, which is considerable, which is enormous and almost unseen before. But as the crisis evolves, these figures might well change to the better, but probably to the worse, because as I said, the scenario are all downside scenarios. Now, what is striking is this study by Koff, and I understood that for CFA Society, or Janek Bert-Sturm was presenting a seminar earlier on, is in different scenarios, and I don't need to enter in the different scenarios of Koff, they calculated the costs in Q2 for Switzerland. And the costs have 3 components. One is the direct cost of the lockdown. Second, the pink one is the costs of the labor supply with quarantine, with lack of, with maybe sick people, and also people not able to travel, being less productive. And there's the big chunk of costs is from international developments. As you know, 1 of 2 Swiss francs are earned in the sector, in the export-oriented sector. Now, if you assume that Switzerland manages better the crisis than its main trade partners, then it's easy to assume that the costs imposed by the export-oriented sector is more than 50%. In other words, if we are now talking about how to unlock the economy, we de facto have just this little, relatively little green part directly under control. And for the blue part, for the majority of the costs, we just have to be confident that other countries are managing the crisis as well as Switzerland. And but this is somehow an exogenous variable to the Swiss economy. Now, on the second question on the inflation, I mean, I just use a textbook economics 101 example, what happens usually in a crisis. And we see that in a crisis, usually it occurs because households are not confident about the future. And there is a lot of uncertainty surrounded for the industry, and therefore they decide not to invest anymore. The demand to goods and services goes down, and so go the prices. crisis. Now, the particular thing here in this crisis is a combined supply and demand shock. I mean, the supply of certain goods and services stopped due to the lockdown and due also to the interrupted supply chain. And if the consumer are quite optimistic then about the future, then of course the supply shock will be stronger and drive up prices simply for the scarcity of the products. So there are two forces currently at work, and we will see in the future which way it goes. In March, prices went down by 1%. So there are different types of possible developments. If it's a short-lived demand shock, probably prices will go down slightly and the SMB will be back in control of the prices very soon. If there is a long-lived recession that affects production and firms that were profitable and very productive, then of course this extends into the financial sector. There will be a broad instability and prices will probably go down. And on the other hand, as I explained, there is a third scenario where prices could go up. The base case, as I showed you earlier, is a short-lived demand shock currently that would dominate and with prices slightly decreasing, but mainly remaining in check of the central banks. Of course, depending on the type of shock and the type of crisis, different measures would have to be taken. And it's very important not to jump the gun now and for the governments and just really follow this crisis and take additional measures as the crisis goes forward. At the moment, I would say that if it's a short-lived demand shock, the measures of the Swiss government and of the central banks are very appropriate. The last slide on this one is, as I have said, there was fiscal expansion in many countries throughout the last decade. And of course, many countries have much less firepower than Switzerland does. And this is exactly what is in the left panel of this slide. For instance, Italy has just 1.4% of GDP dedicated to fight the corona crisis. And of course, what happens is immediately Italy's credit rating was cut just to one notch above junk level. So we can assume that some countries will not be able to outgrow the debt burden in the future. So what will happen is probably they will have to think about a restructuring, or they will try to increase the inflation. I mean, there is enough liquidity out there to trigger this inflation, or introduce special taxes, or a mutualization of their debt, for instance, through corona bonds in the European Union. But all in all, I mean, this picture is very very much in according to what we see before. Countries that tend to have stricter fiscal policy and the lower debt to GDP ratio, they are now more easily able to really pull together big rescue packages. I'm sorry, I'm now, let's add where I was. And I would like to enter now the three focus topics that I announced on the economic competitiveness. As you know, that a crisis is always an opportunity to do better than before. Switzerland in all or in most competitiveness ranking innovation indices ranks among the top 10, sometimes even is the top, is the leading country, except in the making business indicator, where it just ease of doing business indicator, where it just ranks 36. Now, it's important that we defend these rankings, and it's important to understand what type is this crisis. It's a crisis that is a hit on entrepreneurs. It's not a hit on employees. Of course, there are many jobless, there are many Kurzarbeit, but the social protection has so far worked very well for them. But the packages that have to be pulled together is now really in favor of the entrepreneurs. Think of the credit facility for the small and medium enterprises to avert liquidity strains. We are not sure, however, if they will be profitable again if the recession should last longer. So what are the risks? There is one risk, of course, is a second wave of stress. The second wave would be worse than the first one because the economy entered the first wave of stress pretty sound, whereas in the second wave of stress, a lot of firms have already lost their profitability and resilience. Now, if there is a possibility of a second wave of stress, entrepreneurs, and this is very rational, become more risk averse. They say, we will invest, but only if we have some government guarantees to do so. So what could occur is some type of call option mentality. You would just take the upside potential, but you don't want to bear in these uncertain times the downward risk. So this would be very detrimental. A culture in entrepreneurs would be very detrimental to the competitiveness of Switzerland. And the third risk is also whatever it takes policy style Mario Draghi in terms of state aid and political radicalism. I mean, it's very popular to spend money today, and everyone that says that we should also be watchful not to spend too much is not very popular. So politicians are aware that that there is now a demand for state money, and there will be very few exposing themselves to be restrictive at this moment. But of course, whatever it takes money is by definition excessive. And the fourth crisis, or the fourth risk to the crisis, is that too many people treat this crisis simply as a normal crisis, which has a wider extent, but then goes back to normal. Clearly, this has happened during the financial crisis, where some banks thought, well, it's just, we just need to resist this crisis and there will be a back to normal again. But we saw that there was clearly a paradigm shift in the Swiss and European banking sector, and banks that were prepared for this paradigm shift were better prepared later on. So two messages here. The state should avoid breeding zombies by excessive fiscal expansion, and the firms need to stay innovative and serve the customers' new preferences. First, on the zombies, there is by McGowan a study that showed how countries that has had a more excessive fiscal policy and non-temporary, but ever more excessive, was really breeding zombies. Why are zombies as bad? They reduce productivity on a whole, and there is however, a disincentive for central banks and governments to restore normal conditions, because many political decision makers would favor having people work in zombie firms that having them unemployed. So there is a choice to make. But in the long run, definitely state aid needs to be timely, which it is in Switzerland, targeted, which it is so far, and we need to make sure that it is temporary. It's always easier to enter a war than to pull out, because we have not set in advance the conditions to pull out. And maybe you know the joke on the left-hand side, and it's not a joke. I mean, it's just a social media contribution. But thinking of your company, I am sure that many of you see now the necessity that the digitization is really of a first order priority. So far in many firms, it has been just an ICT issue, but now it certainly has become an IT issue. So an overinvestment in technology really contributes to the preparedness of firms, and in the end also to the efficiency and profitability of any firm. We have seen this now in the banking sector quite dramatically. Second focus topic is monetary policy. You remember that the Swiss Bankers Association published a study in October last year, ahead of the 5 years negative interest rate anniversary. And from October till January, till just before the Corona crisis, I think negative interest rates were at the forehead of most economists here in this country, and startlingly also elsewhere. But of course, monetary expansion was not just negative interest rate. Worldwide, there have been QEs, as shown on one of my first slides. We have softened collateral requirements, special purpose vehicles, etc., etc. 10 years ago, we used to name them unconventional policies. Now it seems they have been pretty conventional. Despite the fact that, for instance, negative rates take their toll on competitiveness, we have an asset inflation, social security, where does we get the return on investment from, and of course the risk-taking. Negative interest rates show that there is something not in order, and so people are more careful and are doing a lot of precautionary savings. Two issues I would like to mention here is first, an extensive monetary policy or interventions take their toll on central bank independence, and second, an alternative policy stance is possible. Of course, now it's not the moment to discuss it, but it certainly should be discussed in after the crisis. What is particular about this time, maybe also a little bit as a fun fact, this is this study by Schmelzing published by the Bank of England. He dates back monetary regimes for 700 years. And we see that the current, or we see the vertical pink bars indicating tightening regimes, and the green bars easing regimes. And we see that currently we are in the second longest easing regime in 700 years of monetary policy. And we are bound now, given the crisis, for the longest monetary easing event in history, in economy, you can not even say in modern history. It's really dating back to the 14th century. Now, of course, as balance sheet get bigger, as the influence of, or the dependence on the zero interest rate becomes bigger, of course, the demand and the political exposure of monetary policy gets bigger. For instance, the US government, we know the tweets of the current president, he criticizes monetary policy, and suddenly there were these emergency cuts on March 3rd. Also, when Ms. Lagarde made her first speech into the corona crisis, she disappointed markets, and she has been quick to redress the situation. So central banks are not just at the margin of the economy, they are at the center of the economy, and of course the demands of and the political pressure goes along with the position that central banks currently have due to their overly excessive interventions. The search for an alternative policy stance, now taking up the negative interest rate discussion from before, I would like to point to two recent studies that have been published, one by the Swiss National Bank itself, the other one by the Professor Kaufmann of the University of Neuchâtel, and both see that suppose that the Swiss National Bank withdrew these negative rates and went to zero, what would happen to the exchange rate? Of course, this is historic data. Of course, this is not in a corona environment. So, of course, we have to take these results with a salt of grain, but with a grain of salt, excuse me. But the main message is that the Swiss franc should not go through the roof in normal times with respect to the euro. Of course, there are some preconditions. We had to have a policy review, maybe a change of inflation target. Now, certain exponents have talked about reintroducing a fixed exchange rate again. This monetary policy discussion will not go away, but is of course now a little bit in the background because we need now the firepower of the central banks to fight this crisis. Last but not least, a word on pension funds. In our study that we published 1 year ago, we showed this slide. We have the bond yield of Swiss Confederation bonds going even below zero, whereas the target return that pension funds have to yield to achieve has not decreased by the same speed. And therefore, there is more return needed in the future. And the question is legitimate. Does corona crisis act as a third stress factor to our pensions? The first being the low interest rates, the second being the lack of reforms not taking into account the demographic evolution. And now maybe we have a third stress factor as the corona crisis. My opinion on this is that if we can stay with the base case of a V-shaped recession, this means a very limited lockdown as we experience currently, and our main trade partners are equally successful in starting their engine again, then it should follow that in the medium to longer term, we will be able to maintain our production capacity. Our firms will be back to be profitable again, and will contribute and allow financial investors to have the risk or the return according to the risk. So it seems that if we are really in this base case that really looks the most probable in terms of probability right at the moment, then I'm not too much afraid that there will be a longer lasting corona crisis in the pension system. Now, of course, we may talk about strategy, we may talk about recommendations by the banks that you should now buy investment grade corporate bonds because certainly governments will not let down these firms. I would not like to enter too much into this discussion. You know better than I what the actual recommendations are. Much more I'm interested in this slide by the International Monetary Fund in its latest Global Financial Stability Report. And it takes a comparison between different market actors during the financial crisis and during the current crisis. Now, the red in the top panel, the red lines show the degree of vulnerability of the insurers, of the banks, of the households during the crisis. And we see that only sovereigns and the non-financial firms, namely the real economy, are more vulnerable today than they were during the financial crisis. Of course, if you look at the bottom panel, this evaluation varies widely across the economy. So if you're thinking of an asset allocation, it's equally important to see how do the conditions change throughout the different regions. I think this is now important to see how, for instance, banks fare in the United States and in the euro area, or how the households fare in the euro area, much less vulnerable than in the United States. So here is a second component that drafting your strategy should be taken into account. Now, my last slide focuses a little bit more on banks. We just have seen that the banks are much less vulnerable to in this current crisis compared to the Lehman crisis or to the financial crisis 12 years ago. But if we take the second panel from the left, we see the equity or the stock price development in days after the Lehman event and in days after the lockdown. And you see that the stock prices in black and the CDS spread in blue are pretty much the same. So we really have to be careful to say the banks are more vulnerable than in the financial crisis or are less vulnerable. I mean, it's really a lot of uncertainty here. If you take the right panel, you see the different regions and the downgrade outlook. And you see also here that European banks seem to be most affected here. This would be really in line with the IMF observation that the European banks, the euro area banks, on average, of course, there are wide differences, but on average have been downgraded and have a hard time. So let me come to my last slide, wrapping up and making an outlook to what actions I think are needed to get to this new normal, because asking myself, will we ever back to normal? I say yes to normal, yes, but maybe it's not the old normal, but it's rather a new normal. Of course, at least now, every firm should be aware that it's now time and it's urgent to engage in the end-to-end digitization. It makes a firm much more resilient to shocks. It is able to overcome the fragmentation of the global economy, because you know that there are a lot of political push towards autarky, towards deglobalization, and of course, the standard argument in favor of digitization is still efficiency, boost efficiency, and this continues to be true. Now, the second one is with respect to the fiscal packages. Of course, we need now strong actions by the governments. We have seen strong actions by the governments, but we need lending powers. Sometimes we have to pay back the debt we are now currently incurring, and we don't need spending powers because persistent financial supports, as we have seen, create zombies and is to the detriment of competitiveness. Maybe as a third point, there are more tail risks now taken into account when drafting strategies. I mean, the possibility of an epidemic after SARS and MERS was really widely discussed, and nobody had it on its radar screen, maybe on the radar, but did not take a forceful action. After the financial crisis, we all knew there will be inevitably another crisis. Me, myself, I wouldn't have thought that it would be triggered by a virus, and probably many of you would not have thought this either. And to the very last point, there are new political realities. The more jobless people we have, the more people we have that cannot access health services, school services, abroad, of course, there will be more political changes. And for some psychological reasons, when there are big questions out there, big questions about the future, somehow people trust more authoritarian governments than democracies as Switzerland. And so this is probably my main concern now, is that we will see deep political changes throughout the world. And finally, we stand alone with our democracy here in Switzerland. So I would end this presentation and I would hand back to Sheila. Thank you very much.
Thank you very much. Very thought-provoking on in many ways, and as reflected in some of the questions that we've been receiving from the participants. Ivan Guito has a question. In practice, how can the governments avoid to feed the zombies? Are the measures announced so far going in the right direction, in your opinion?
Zombies are firms that in the long run continue to exist. For instance, in Greece, we think that before the corona crisis, 35% were zombies. So the economy cannot provide them enough, or they are not strong enough, and they are not competitive enough. Now, of course, we will not have zombies in the long run if state aid will be withdrawn. In Switzerland, we have a credit facility. These credits have to be paid back in 5 years. And I think this is assurance enough that by then, firms who were not able to pay back their credit cease to exist. So this is a guarantee that zombies won't stay in Switzerland. It would have been different if Parliament had voted in favor of a spending program and with no payback of these 40 billion credit.
Just a follow-up question. Does that have any implications for the defaults seen in the banking sector for their loans?
I think the default seen in the short run is absolutely in check. And if we stay with the short run, with the V-shaped recession, then I'm absolutely confident that we don't see a mass default, on firms. Of course, we can be as dark as possible with a prolonged recession. We don't know where it would go. It's, of course, larger than 0%. But in Switzerland, we can be confident because really Swiss banks after the financial crisis made their homework and beefed up their capital. And so they have a lot of cushion there if certain firms should go bankrupt.
Thank you. Another question on the quantitative easing and the general viability, long-term viability of the quantitative easing. Tommaso Scalesi says, we saw from your slides that debt has only gone up in the last 20 years. Will the government debt be monetized, leading to very high inflation?
I try to give an answer to this. I mean, if you want to reduce debt because you cannot outgrow, you have the possibility to monetize it, exactly. And probably some are hoping that inflation picks up. And so central banks were indeed a little bit less strict and more generous with liquidity. But there are other options. We can mutualize them, so have them put the burden on other countries like Germany within the European Union context, or we can just do a debt restructuring. Argentina has now ceased to pay some of its debt. So there are various options, but of course, many governments hope that it would be monetized indeed.
Following on with the policy of the central banks and the political implications, Giuseppe Valoci asks, what about the impact on Switzerland and the euro-Swiss franc exchange rate of the current, given the current structural crisis in the European Union?
Yes, I think this is one nut that is very hard to crack. I mean, the Swiss National Bank does not have a very easy task. I think most of us would agree that, of course, Switzerland will not come out unharmed. I mean, there's a huge welfare loss in Switzerland too. But relative to Europe, countries of the euro area, probably we would agree that Switzerland fares better. So the safe haven characteristics of Switzerland are likely to be reinforced, and this means that most probably the upward pressure on the Swiss franc will continue for some while.
Carrying on the quantitative easing side, Arno van der Heiligenberg asks, what is the view of the stakeholders in Switzerland to the arrival of modern monetary theory in the world? And do you see it coming to Switzerland as well?
Well, I think this is a very interesting question. I think this is now the moment where all kinds of theories can be discussed, will be discussed. I think there are no more taboos in terms of loud discussions and interaction. I think it's good to lead these discussions. My personal view is that I think it is very, very difficult to implement an untested theory independently of what theory it is, but an untested model in the deepest crisis in decades. So I would really warn countries to follow, to go down this, or central banks to go down this path, of course. But I'm really open to discussion because we are definitely in a different period, and we must be open to new ideas. We must be open to new ideas, but the new ideas carry the risk that they have no history and no experience with these new tools.
Thank you. Just turning towards the profitability or the banking sector, Giuseppe Ballocci asks, what are your views on the profitability of banks going forward?
I don't know whether we talk about European banks or whether we talk about American banks. I think it's important that banks make their homework, namely in the terms of digitization, because I think the business model will change in the future. And you can see even before the crisis, I mean, the stock prices were really low of the banks in Europe. So that means that profitability even before the crisis will go down. I'm sure that there will be some structural change in the banking sector. Some banks will do very well. They are forward-looking. They are digitizing their business, and they have that can lower their cost base. And others, evidently, as in all the crises, they will come too late. But all in all, especially for the Swiss banking sector, I am relatively optimistic that within Europe, it will continue a predominant role here. I mean, we are really, we have really gone forward in Europe. But of course, if you compare to the golden times before the financial crisis, you should not do this comparison, of course.
Just following on, there was a question asked previously. In which subsectors of digital banking do you see the greatest potential at this stage?
I think, first of all, is the cost basis. I mean, we have now models of mobile banks with a really low cost basis. And I think that the pricing just has to be right. Now, there are some offerings where you can simply not make the difference anymore, maybe mortgages. This has to be automatized. And we also have to be very creative in tackling the open banking issue. I mean, sooner or later, I think that banks on a large scale will open up their interface so that third-party providers from mobile phones can hook up to banks, and the banks have to be confident and to see the opportunity that they are not just giving out data to third-party providers, but they should be able to use data for their new offerings and business models. So I think there is a lot of opportunities we cannot even imagine, but if later on we will have self-driving cars, I mean, the question is where this car should be from a car company or whether it should be operated from a bank, because if I use a self-driving car, it's not my own. So there are, digitization really opens a large range of creative opportunities. And it's also in the short run, I mean, without digitization, we would never have been able to handle hundred of applications of small and medium enterprises for these credits.
Just to follow on that, Thomas Burry asks, will the banking landscape still look the same in 5 years, or will the established banks be replaced by digital banks?
I think this segmentation between digital banks and traditional banks, I think this sharp line will vanish. I mean, we see also in Switzerland that traditional banks have their digital brand. So it matters. It's less a matter of differentiating. I think this border will blur with cooperation, having own brands or participations. I think the the business models are clearly open, but what I will see is, or what I expect to see is that we are really, the demand for digital banking offers will increase, namely also because if there is one winner from this Corona crisis, it's digitization.
Mm. Just specifically in Switzerland, will the current crisis and government response add to or subtract from the pressures for the number of banks in Switzerland to shrink?
I think, of course, if you took the alternative of not having a package at all, I think that there would be a disastrous recession, and the number of banks would really go down. So I expect in the future the number of banks to continue to fall. I mean, to follow the trend of the last few decades. This is for sure. But the government aid is preventing the economy and the banking sector from a meltdown, of course.
Turning to more the European banks, in your view, what are the key reasons European banks are in worse shape than the US banks?
We have seen that that simply European banks are not as profitable as US banks. And this is basically because, first, of their interlinkages with the sovereign. For instance, in southern European countries. And I think the cleansing in the banking sector in the US has occurred much more vigorously after the financial crisis. And it's simply also a matter of size. I mean, among the largest banks in the world, we have apart from Chinese banks, which per definition are very large, we have mostly US banks. Swiss Bankers Association has issued a publication last year, do we need large banks? And we are really treating this problem. I see for European banks, one solution is that you finish the banking union, the fiscal union, and only then will banks be able to grow and be pan-European banks. We have seen the talks between Deutsche Bank and Commerzbank. This couldn't go well. In the future, the European Union really has to finish the banking union.
Thank you. We have many questions, but I'll finish off with a very provocative one for you. Because of the indebtedness of private households, do you expect social unrest to take place on the streets?
Probably not in Switzerland. We saw, and I think this morning, or just in the last few days, there was a Credit Suisse study that showed that really the precautionary savings of households in Switzerland has increased. So that means, paradoxically, at this moment, they have more money available than they had before, simply because either they were more careful to spend it or they did not have the ability to spend it because of the lockdown. So currently, we have more money as a household, and the social protection, Arbeitslosenversicherung has worked very well in Switzerland. But I see definitely social unrest in countries where social protection is inexistent, is insufficient, where you have sick people that cannot go to a healthcare center. This is where problems are, and yes, I expect some unrest in those countries.
Well, I think we'll end on that. I'm sure there's a more positive notes, but that's the most provocative note. But what I'd like to do is thank you, Dr. Hess, for a very informative, very interesting presentation. I'd like to thank all the attendees who've, including those who've provided very interesting questions. And finally, I'd just like to thank our sponsor, JP Morgan. Thank you again.
Thank you.